secure investments, we secure your future. In the ever changing landscape of finance, one thing remains constant the need for a reliable partner. At Yes Securities, we are not just wealth managers, we are architects of financial success. Our experience over the last decade has been a steady and remarkable journey leading to growth in the labyrinth of financial opportunities. We don't just find a way, we create it. We don't build walls, we build bridges that connect ambitions to achievements. Innovation is not just a word for us, it's the heartbeat of every decision we make. Your success isn't just a goal, it's our mission, our commitment to your financial journey. We provide world class solutions across multiple products, catering to institutions, high net individuals, and retail investors across sectors. Because your success is our business. Yes, Securities, empowering tomorrow.
Hello, everyone, and good evening. Welcome to our third session of Yes Pen Pulse, our webinar series dedicated to exploring the technical aspects and having broader discussions in finance. A world where financial decisions are not intimidating but empowering is precisely our mission at Yes Securities, where we enable people, anyone and everyone, to make financial decisions accessible regardless of their background or experience. At Yes Securities, we don't just facilitate transaction, we also enable transformation. Over the past decade, we have evolved from being a transactional broker to a trusted advisor for both retail and institutional clients. Before diving into our today's topic, let's take a quick moment to reflect on our previous session. Just this last Wednesday, we had the privilege of hosting the first part of How to Avoid Landmine in Investing, which I hope you all found that session as enlightening as I did. Now, getting down to our business for the day, our topic is the basics of fixed income. It's my pleasure to introduce our esteemed speaker for the day, Mr. Sachin Shardal. Mr. Sachin manages the multi asset desk at TS Securities Limited with a keen focus on fixed income investments. Also, last April, just this April actually, April 15th, he finished 5 years with us, also with approximately 12 years of extensive experience in product and investment management. He has been a valuable asset to various companies, including us, throughout his career. Today, he will share his deep insights and knowledge on the basics of fixed income, a critical area of finance. His expertise and experience makes him uniquely qualified to guide us through this subject, helping us to understand its nuances and application. And guess what? If you miss any of our sessions or want to revisit the sessions, don't worry. We will be uploading the entire series to YouTube under playlist named Yes FinPulse, so you can catch up at your convenience. And also remember, this is just not one way street thing. We will also like to hear from you. After Sachin's presentation, you don't hesitate to ask any questions or drop your doubts in the comment section. Your engagement is what going to make this session truly special. We also have polls and quizzes coming along the webinar, so be alert. Over to you, Sachin.
Hi all. Thanks, Shraddha, for that wonderful introduction. So, guys, I'll be taking you through the basics of fixed income. This is the first time we'll be discussing fixed income as an asset class. So the endeavor here is to kind of take you guys through the most basic aspect of what fixed income is. Only and only once we understand what the basics of this entire asset class is, we'll be able to deep dive into this particular asset class in our upcoming sessions. So again, as Shraddha said, let's keep it more interactive. I have like two to three very easy, simple questions coming along, just for me to understand. You guys are able to grasp what I'm kind of saying. And at the end of the session, I'm more than happy to kind of take all sorts of question under fixed income. Uh, I'll just show my PPT and then we can start. Okay. I'm hoping you guys can see my presentation. So let's get into it. So agenda for this entire, uh, this session would be, we'll first understand what capital is, then deep dive into what fixed income as an asset class is, what constitutes as, fixed income, what are the components, that you should understand or realize when you kind of, want to assess or understand fixed income, and then just a few, benefits on what about fixed income, and what fixed income brings to the table, while investing into it. And we can obviously have a Q&A post that. So just moving on to our first topic. So what is capital? So capital is nothing but, money required, for your business. From a business sense, it's a money that is required to, kind of extend your business, or maybe, for whatever business plans would you have, you would need some sort of, money which kind of constitute as capital. So there are two types of capital. One is obviously owned capital, and then again the second one is the borrowed capital. Um, so just a small question that I can, I want to start with, before we kind of go forward into. So there is this question that is live on your maybe screen. If you could quickly answer. Okay. So I guess the question is kind of, live right now. So what is own capital and what is borrowed capital? So there are two options. If you can quickly kind of click and answer, then we can quickly move on to that. So basically, owned capital meaning, some the capital that you own would be something that's your own money, can be constituted as an equity, from a business perspective, from a businessman perspective, if you're owning a business, right? From an investor perspective, also it's the similar. When you invest in a particular business, and when you own the business, that is constituted as equity. So whenever you are trading online in markets, and when you kind of invest in a particular company, or when you kind of buy a particular stock of a particular company, meaning you're becoming a owner of that particular company to the amount that you invested. So that can be constituted as equity. Owned capital is equity, right? So as I said, equity is fund that is invested by the owner in their own company, uh, could be introduced by promoters or equity shareholders. So equity shareholders can be investors, right? And obviously, being a shareholder of the company, you get voting rights, and you are an owner of that company, as I said, to the extent of investment that you have. And you, at the end of the day, your investment, will give you profits and loss as per the company's performance. So that is equity, and equity has been covered extensively through our this thing in our past sessions. So what I want to kind of try and focus your attention to is the borrowed side of capital when it comes to business. So as the borrowed capital, as I already said, is debt. So debt is nothing but a loan that has been taken. It could be from anyone, right, to expand your business. So you have to consider or think from an perspective that if you are a business owner and you want to extend your business to a particular level, you need capital, and there are only two ways capital can be gathered. One is equity, wherein you shall you make people part owners of your company, get their money in and expand your business. Other is, instead, if you don't want to dilute your company, you kind of take loan from whoever, maybe your friends, family, bank, or multiple investors that would be there to kind of invest in your company. So that becomes debt in fixed income. So now, from an investor perspective, if you kind of look the same way, from an investor perspective, when you want to invest in a particular business, there are two ways to invest. One is either you become a equity holder. Basically, you become a stakeholder in that particular company, or you loan money to that particular company. Now, when you're loaning money to a particular company, you expect that entire money to be coming back to you with a certain sort of interest. So fixed income space deals in this particular area. So basically, fixed income is nothing but funds raised through banks, loans, debentures. Debenture holder meaning investor who is loaning the money to a particular business is promised a fixed interest rate return, and they become lenders to that company. So post establishing what is capital, let's look into fixed income in little more depth. So what is fixed income, and why do we say, why is this term fixed income, right? So as we already saw in our previous slide, debt is nothing but a loan that has been given to a business. So basically what happens is this particular debt is constituted or represented as a bond. So basically bond is essentially represents a loan that can be turned into a security, which later can be traded in the market. So basically when you're lending money to someone, they in exchange you'll get a bond as your security that you'll have. So basically whenever the company is about to pay you back, you'll have to give that bond back and take your money back. So again, lending is does not necessarily only happen via banks, right? So company can get money from multiple avenues. So instead of going to the bank, the company gets money from the investors, and who in turn will buy this bond, right? So in exchange for the capital, the company will pay. Once you give a capital to the company in turn will pay you, an interest, interest coupon that is, as per the agreement, that is expressed in, as a percentage of face value. We'll get into the nuances of these, jargons as we move on in our presentation. So basically, the company will pay interest at a predetermined interval and return the principal on the maturity date, and basically ending the loan. Unlike equity, wherein until unless you don't transfer your ownership to someone else, you won't get your entire value back. Fixed income, when you are lending money, loan obviously has a tenure, right? Post the tenure ends, the contract ends, you get your money back, you return the bonds back to the investor, right? Now, so basically what we've understood, or if I have to summarize this entire thing, bond represents a commitment by an issuer to repay the amount back at some point in the future, usually with the interest, hence the term fixed income, right? So one thing that I want you to kind of understand or take back through this entire presentation is bond represents a commitment, right? At the end of the day, when loan is taken, has to be paid back, obviously. So once the session or these sessions we keep on taking forward, we'll also deep dive on how we can do the credit analysis, etc., etc. But one thing we have to understand, why fixed income? Because it's a commitment by an issuer to repay the amount back with some certain sort of interest throughout the loan tenure. So that was the basics of the what fixed income is. Now let's understand what components of fixed income is. Basically, components. What I generally mean at components is fixed income. Basically, these are the aspects that you will have to understand or know while investing or understanding a sort of fixed income security that you will come across in your investment life. So these are 4 or 5 components that you will have to understand. One, and the entire fixed income space more or less revolves around these components. So once you understand these components, you will be able to understand the basic of how to analyze or understand a particular fixed income security. So one is coupon, second is face value, then maturity, rating of the particular fixed income security, and then finally yield or price or return. We'll see this, we'll discuss this in details as we move forward. So starting with coupon. So coupons pretty basic. Whenever we'll throughout the presentation, we'll keep referring to our initial example of lending money to a business. So when once you lend money to a particular business, there is a certain sort of interest that business will promise you to be given. That particular interest is pre-decided, and that component is called basically a coupon. So interest rate the bond issuer promises to pay to bondholder until maturity. It is generally expressed in an annual term. So if I say I'm getting a coupon of, for example, 10%, meaning I'm getting 10% on an annual basis, right? So just to move on to the presentation quickly, we'll take a second question related to the same thing. So I'll get an idea if you guys are kind of so the question is very simple. A bond which pays 8% coupon will pay dash per 1,000 rupees of face value per year. So basically, if the face value of a particular bond is 1,000 rupees and 8% is the coupon, the example basically was, consider a bond which has a value of 1,000, and there is an 8% coupon attached to it. And so basically, what investors will be getting every year would be 80 rupees. And at the majority of the bond, the client will get his 1,000 rupees back. This is the simple basic of how this particular debt investment will work. Anything and everything will be revolving around, what sort of coupon it is, what sort of face value it is, what sort of a tenure this particular bond will have. Right? Now, there's a exception when it comes to coupon, when it, as I said, is component. So a lot of securities which get issued might not have a coupon attached to it. Meaning, what happens is, instead of giving 1,000 rupees as a loan, what a particular zero coupon bond will do is, I'll give 95 rupees as a, or whatever, 900 rupees as a, my investment amount. On maturity, I'll get 1,000 back. So instead of getting 80 rupees year on year, I'll just get a higher, principal back at the term of maturity. Uh, so this is basics of what coupon is. Then moving on to face value. So face value is nothing but the initial value of a particular bond. So when at the day one, when an issuer is going to kind of give you a particular bond, he'll also pay a coupon on the face value. So face value is the initial fixing price of a company that is fixed at the time of issuance. uh, Face value is also known as par value. And generally name or the coupon is always and always calculated on the face value, and on maturity, face value is what you get back. So basically, if a particular, in our previous example we saw, face value of a bond was 1,000 rupees, so the coupon will get calculated on face value itself. That face value will never change, and at the maturity you will get your face value back. So if you bought two bonds with a face value of 1,000 rupees, that means you have invested 2,000 rupees, in the particular bond, and you will get 160 rupees as your coupon. And on maturity, you are going to get 2,000 rupees back, right? And face value is the face value and coupon. These two aspects are constant until and unless explicitly stated by issuer, right? They'll in your agreement, whenever it is explicitly stated, face value or coupon will always and always stay constant. They'll never change, because as we already have discovered, that it is a commitment, right? It is a commitment that issuer gives to pay you back that sum that he is borrowed. Moving on to the maturity date. So maturity is nothing but, it is as simple as the word gets. Maturity is nothing but the end day of the loan tenure, right? Date at which the principal amount of the security is scheduled to be repaid to the investor, including whatever interest payout of final few months, if there is any, right? So maturity date is very important. Then there is again an exception, right? One is the call option and a put option. As the name suggests, date at which issuer and investor respective their right of redemption of the security. Just to take an example, if a debt paper is for a tenure of a 10 year with a 5-year call option, what would essentially mean is the loan tenure ends at the end of 10 year, but then issuer is given a call option to investor after the end of 5 year. So what happens is, when we reach the 5th year, investor has an option to issuer has an option to call back the money and give the security back to the client. Vice versa is put option, right? At same example, if there is a put option, investor will get an option at that particular determined time interval to exercise put option, basically meaning he can, he won't he, do, he doesn't have to wait for the end of the loan tenure. That particular date he can exercise his put option, meaning he can give investor his bond back and expect his money back. So basically, that's the majority. This thing. Now, one of the major, kind of aspect or something that is most, kind of looked after or watched is rating. So ratings are nothing but, in a sense, you can just compare it to, the CIBIL scores that all of us individuals have, right? There is certain sort of rating that CIBIL gives you on in terms of your repayment history or the sort of loans you've taken. 900 is considered to be as the highest credit score, and then it keeps going down. Similarly, all these because obviously at the end of the day you're lending money to a particular issuer, right? And the one way to assess very quickly if the issuer is good or bad is knowing, and the most important thing is, once you're lending money to someone, what sort of credit history that particular business has becomes most important, right? Because that the entire risk that your capital has, the most important risk that capital carries is the credit risk. If your guys who lent money is not able to pay back, that's a meaning you might lose your entire capital. So there are two types of ratings. One is a long term rating and a short term rating. Short term rating is basically businesses who are taking money for less than a year, right? And long term rating is for businesses who are taking loans or issues debt securities for more than a year. So now these ratings keep changing from businesses to businesses, companies to companies, subsidiaries to subsidiaries. On a long term scale, AAA is considered as the highest rated security, and then moves on to AA, and then post A there is B, double B, triple B, triple B minus, etc., etc. And short term A1 plus is considered as the highest. Then obviously A1, A2, A3 subsequently keeps going on. So a AAA security might not necessarily have a short-term A1 plus rating. Similarly, a A1 plus rating company might not have a necessarily have a AAA sort of a long-term rating. Just to give an example, when it comes to businesses, maybe it is very easy to take a short-term call because maybe a particular business has gotten a certain set of cash flows or inflows which make the company's balance sheet very healthy for a year, but there is no view you could take post a year. So a short-term rating, when you're investing in short-term instruments, short-term rating comes into more of something that you should look for rather than long-term, because long term obviously it's a the call of your investment is also not long term, right? Um so there's basic of ratings. We'll again obviously, as the sessions keep on going, upcoming sessions, we'll keep on deep diving into all these aspects, how a credit rating method works, what sort of a credit quality you should be looking for, etc., etc. As of now we'll only cover basics. Now, the most important is yield or price, right? What is yield? Or yield is nothing but a return that one will end up investor will end up making once he invests in the fixed income security or a debt security. Though in a basic term, if I had to explain, it is the anticipated return of an investment expressed in annual percentage, right? It takes into account the initial purchase price, right, the anticipated coupons or cash flow over the life of the the tenure, and once the bond is matured, uh, the whatever principal that comes back. For example, a 8% yield means the investment averages an 8% return each year. So your IRR return will be 8%. So there's a example that I've kind of put here. So for example, the similar example that we'll take, security of face value of 1,000 rupees having coupon of 8%. So basically minus 1,000 is your cash outflow 80 rupees is what, inflow that we'll keep getting. And at the term of, maturity, 1000 is what you'll get. So if you calculate this in, so there is a mathematical formula on XIRR. We'll deep dive into again in our next sessions. Once you apply that, the return here will be 8%. Your XIRR return here will be 8% if you tabulate this particular graph in your this thing. So one thing that you have to also understand or remember is, this particular IRR return is, constitute or termed as yield, right? So bond yields are generally, always inversely proportional to the price of the bond. So meaning if, this 1000 rupees, if the price increases here, the, yield will decrease, right? So here again example, if this 1000 rupees, if the value or of this 1000 rupees goes to maybe, 1200, your cash flow will look similar, right? Even if you bought this security at 1000, your outflow will be minus 1200, but your cash flow subsequently will reflect the same. So it will be 80, 80, 80, and at maturity you'll get 1000 back because it is a commitment. So for 1200, you have, for 1200 rupees invested, this will be your cash flow, meaning your IRR will go down, right? Instead of investing 1000 rupees for this particular security, you were invested 1200 rupees, meaning your subsequent IRR will go down. So yield and prices have inverse relationship. Again, these are the subjects which will, take multiple sessions to deep dive. So we'll kind of have one session only on what is yield, how yields are calculated, how yields get impacted, what impacts the yields of particular this thing. Um, One last question that I have here that I would want to ask you. I hope everyone gets this because somewhat the answer is there on the, on the presentation. If you can get the question on screen. Uh, so as I said, if the price goes up, yield goes down. Similarly, if the price goes down, what happens to the yield? Okay. As I said, it is the relationship between price and yield is inversely related. So once the price goes up, yield goes down. Similarly, if the price goes down, meaning yield goes up. If we look in our example again, the same example, the cash flows here will stay the same, 80, 80, 80, and 1000. But our outflow here at the first day would be less than 1000 rupees, meaning the prices drop. So that IRR here will kind of increase. So instead of getting 8%, client will get maybe 9%, 9.5%, whatever the IRR will show. So yield and price have an inverse relationship. So once you understand these basic components of, fixed income, the entire fixed income investment revolves around these, basically these particular components. So what keeps changing is the coupon will keep changing. A particular issuer will, promise you higher coupon, lower coupon, whatever. Face value will keep changing depending on the sort of investors that a particular issuer want to attract. Sorry, if investor wants a more retail participation, issuer will keep a face value of a 10,000 rupees, meaning a client who can invest 10,000 rupees also can buy a particular bond. If issuer doesn't want a retail participation, or if regulator doesn't want a retail participation in a particular security, which already has happened in 81 bonds, SEBI came up with saying that face value of 81 bonds cannot be below 1 crore, meaning a normal regular retail investor cannot invest in that. Only institutional and HNIs who understand the risk behind those particular bonds will be able to invest. So face value will keep changing depending on the sort of investors you want to attract or the businesses would want to attract. Maturity will keep kind of fluctuating. So you have to kind of understand or assess the sort of maturity your debt paper or fixed income security is giving, depending on sort of financial goals you have. So maturity papers are ranging from, maturity of 10 to 15 days or to as high as 60 to 70 years. Government of India papers today, you can invest in a Government of India paper with a maturity of 2065, where the bond matures in 2065. Then moving on to the rating. Rating is one of the most major, concept that we'll have to kind of understand. We'll deep dive this in our upcoming sessions. Rating is nothing but a quick way to assess the credit quality of your instrument or your fixed income security. And yield and price, as I said, that's your final sort of price that you'll be paying for the investment, and what sort of return or yield that you'll be getting on your sort of investment. So everything revolves around these particular this thing. So just to quickly summarize, what are the benefits of investing in fixed income for investor? One, obviously, it provides stability. One thing you have to understand: once you invested in fixed income security and stay invested till maturity, your return is never going to change, right? Come what may, whatever happens in the market, your returns will never change. Second, you will keep getting periodic income in form of cash flows or coupon payouts that has been promised by issuer. There are a lot of tax efficient efficient options that are available to be invested in this particular asset class. Then finally, preservation of capital, right? Once invested, your at the end of the day, it's the money that is lent. So your capital preservation is always going to be there. Then it's obviously for people who want to accumulate wealth over the long term, because once you understand the maturity profile and risk associated with it, it is always prudent to stay invested over the long term, depending on what sort of risk profile one will have. And then finally, diversification. Diversification has become so important in today's day and age. If you see at equity markets, every day equity markets is going up and down. You don't know what sort of, no one actually knows where markets are going to go, what will happen, what result outcome are going to be. In such scenarios, fixed income becomes a very important tool to kind of reduce the drawdown on your overall investment, or to look into such investment classes wherein you don't really have to worry about where market goes, and you can stay put and enjoy your returns over the long term. So yeah, that's it from my end. I'm more than happy to take uh, any questions that you guys might be having. And I already have multiple sort of series planned that will keep deep diving fixed income as an asset class in our upcoming sessions.
Guys, if you have any questions, please drop them in the comment section itself. Thank you, Sachin, for this insightful and wonderful session. As we conclude, let's apply this newfound understanding to make informed financial decisions. To all the attendees, thank you for joining us today. Let's continue to take this journey together and forward. Stay informed, inspired, and empowered. Also, keep an eye out for our informative session, which will be upcoming in the future. Until then, stay connected with us for more updates. Thank you once again for being a part of Yes Pulse.